Thank you, Mr. Chair. Thank you for being here today. If you would just, with a show of hands, do you believe that, as most Americans do, as I've said and as the President said, that taxpayers should not be on the hook for that? Would you agree with that statement?
Yes.
Further, would you agree with the statement that we should have diversity within our banking system?
Yes.
Yeah, I agree.
Specifically, then, would you be supporting our regional banks, our small and local banks, and recognize the undue burden that they potentially are going to be saddled with as a result of a FDI assessment because of these two banks?
As you may know, Congressman, I responded to that issue, and the answer is the FDIC has authority under the law to consider who benefits from the assistance provided, and we'll take that into account with particular attention and sensitivity to the impact on community banks.
I appreciate that, Mr. Gutenberg. I want to specifically talk to Mr. Barr here. For the diversity in banks, when you do your holistic capital review of banks under $10 billion, what would that look like?
We're not anticipating in any way raising capital requirements with respect to community banks. It's not part of my holistic review.
Good. I'm glad to hear that. Second, I'll highlight here $22 billion, as we say in Iowa. That's a lot of money. And in fact, it's 20% of the entire FDIC's fund for this. In order to make that up, special assessments will inevitably have to be part of this. Do you see that being passed along to the top banks primarily, or how will you calibrate that?
Well, Congressman, it's relevant to my response before. We're required by law to pay for any cost to the Deposit Insurance Fund caused by the coverage of the uninsured deposits through a special assessment. We have to do that by notice and public notice and rulemaking, and we have authority under the law to consider the types of entities that benefit from any action taken or assistance provided.
So I understand that, but I just want to highlight the difference here. We had two banks that had 90% of their depositors uninsured at any level, and most banks across America are at 47%. My state of Iowa, in Des Moines alone, it's 70%. And my rural guys, it's 7%. I mean, these are farmers who are looking to plant this spring who know that they have a good deposit there. It's small businesses that are supported by this. What they don't need is ultimately, to my original question, an increase on their cost of living, on their cost of doing business by a special assessment that disproportionately punishes those who are at the medium and small size. Are you committed to making sure that's a priority for you?
Yes.
Excellent. Last question. I want to be brief here. Silicon Valley Bank did not have a chief risk officer, Mr. Barr, for how many months?
I believe it was approximately 8 months.
So almost a year. During that time, they did have 4 members who served on something called the Governance and Corporate Responsibility Committee. And these 4 members were actually on their risk committee, but had no, as I understand it, actual experience in managing material risk. Were these individuals focused on the wrong thing, and was there no true risk management being taken at Silicon Valley Bank in the lead up to the fail?
I can't speak to the particular individuals. I can say that the supervisors told the board of directors and the bank that the board oversight with respect to risk management was deficient. That was one of the findings that was made in the summer of 2022.
So then, did beginner risk management of interest rate risk and liquidity risk cause this bank to fail, SVB specifically?
Yes, ultimately, they mismanaged their interest rate and their liquidity risk, and their very large percentage of uninsured depositors had a massive and unexpected run. As I said, $42 billion on a Thursday, and expected another $100 billion on Friday, and that was just a devastating run for the institution.
So I'd like to ask this question then, and I hope that Mary Daly has the opportunity, Mr. Chair, to testify in person before this committee. But as you're overseeing this, why did she tout the regional Fed's work on cataloging climate risks, even going so far as to assemble a team to study how these risks are likely to impact the Fed's future reserve mandates? And I'll state here that one of SVB's memos from their supervisory credit group claimed they had been working closely with the Fed to inform its agenda priorities, namely fiscal risk to banks from climate change. Were the regulators focused on the wrong risk posed by this administration, Yes or no?
The supervisors were focused overall on the system on interest rate risk, credit risk, cybersecurity risk, traditional risk in the banking system. There are some supervisors who are focused on climate change.
But there was no risk officer to look at the actual dramatic overage that they had of this.